In 2008, the American financial system collapsed, triggering a global economic panic. Logically, investors should have fled the epicenter of the crisis. Instead, capital from all over the world flooded straight back into the United States. 3 years later, political gridlock over the debt ceiling pushed the U.S. government to the brink of technical default. Standard & Poor's downgraded the federal government's credit rating from a pristine AAA down to AA+. Standard economic theory dictates that a downgraded borrower must pay higher interest rates to attract wary lenders. But the market did the exact opposite. Global investors poured massive amounts of money into U.S. Treasuries, driving the government's borrowing costs to near-record lows. Economists call this the safe haven paradox. The global financial system is so deeply wired to the U.S. dollar that when the American economy catches fire, the rest of the world instinctively runs into the burning building to hide. To insulate their domestic economies from volatile global capital flows, emerging markets have to hold enormous stockpiles of foreign exchange reserves. It acts as a form of self-insurance. Recently, that insurance policy has started to feel like a liability. After the United States froze Russia's central bank assets in 2022, other nations began looking for alternatives, prompting a sudden rush to stockpile physical gold. This chart visualizes that shift. Notice the sharp spike in gold demand by central banks, jumping from an average of 500 tons a year to over 1,000 tons post-2022. During this same window, the dollar's share of global forex reserves dipped from 66% down to 56%. Finding a true replacement for the dollar requires a currency backed by a massive, highly liquid bond market. The Eurozone lacks a single unified sovereign bond market, and China's financial system remains heavily restricted by strict capital controls and institutional mistrust. A simple lack of alternatives does not fully explain why investors continue to pour trillions into American debt. To understand the true source of that trust, we have to look closely at exactly who is lending the money. The United States public debt sits at tens of trillions of dollars. If we examine the ownership ledger, it splits cleanly into two distinct groups: foreign investors and domestic investors. Roughly half of all U.S. public debt is owned by the rest of the world. This group consists largely of foreign central banks and private international investors. Export-driven economies like China earn billions of dollars through massive trade surpluses. To keep their own currencies from appreciating and their exports globally competitive, they recycle those dollars directly back into U.S. treasuries. These foreign governments are reluctant financiers. They fund American deficits to protect their own export models, all while carrying the lingering anxiety that the U.S. could eventually inflate away the value of the debt they hold. This brings us to the domestic half of the ledger. There is a common assumption that domestic government debt is held broadly by ordinary American retirees and pensioners. The data shows something entirely different. This area chart breaks down domestic treasury ownership. The top 1% of U.S. households, alongside large corporate mutual funds, hold roughly a third of the public debt, vastly overshadowing the holdings of the bottom 90% of the population. In political economy, this dynamic provides credible commitment. Because America's wealthiest citizens own such a massive stake in government debt, they use their immense political influence to ensure that Washington honors those bonds above all other financial obligations. This domestic power structure acts as an ironclad guarantee for foreign investors. They know the U.S. government will not default or drastically inflate the debt, because doing so would devastate the portfolios of its own financial elite. This creates an invisible bond between two distinct groups. The sheer political clout of America's richest 1% serves as the ultimate insurance policy for the sovereign wealth of foreign governments. The United States receives a tangible return on investment from this global arrangement. The world's insatiable demand for treasuries provides the American financial system with a bottomless supply of cheap credit. This capital influx acts as a fiscal shield. It allows Washington to finance ongoing budget deficits entirely through borrowing rather than by raising revenue. Because the government can borrow so cheaply from abroad, it faces far less pressure to implement progressive taxation or wealth redistribution policies to balance the budget. This dynamic also pacifies the broader population. Foreign capital pushes down domestic interest rates, offering cheaper mortgages and consumer loans. This allows low and middle-income Americans to debt finance their consumption and maintain their living standards, even as their actual real wages stagnate. The global appetite for the dollar perfectly sustains the domestic status quo. It actively protects the fortunes of the wealthy from taxation, while using accessible credit to dampen social frustration at the bottom. Economists describe a macroeconomic paradox known as the Triffin dilemma, the idea that constantly printing dollars to satisfy global demand will ultimately erode the currency's credibility and value. Right now, the U.S. is heavily testing the limits of that credibility. By weaponizing the dollar network to freeze the sovereign reserves of adversarial nations, it has given foreign central banks a compelling reason to exit the system. Yet, tearing this architecture down is practically impossible. A mass sell-off of U.S. treasuries would instantly crater the value of the dollar, vaporizing the savings of the very nations attempting to escape it. This is the dollar trap. It is a self-reinforcing loop where the vulnerability of foreign economies permanently subsidizes domestic inequality in the United States. The U.S. dollar serves as a protective, prickly cocoon for a troubled world. It is a deeply flawed equilibrium, locked firmly in place, because everyone involved has far too much to lose if it shatters.